What is happening, crypto fam? Get ready for a rapid-fire download of the biggest stories shaking up the digital asset world, because today the markets are moving fast. We've got major price swings, shifts in institutional interest, and big predictions that could redefine the future of finance. You do not want to miss this. It's your essential briefing for what's happening right now. First up, the ground is rumbling in the crypto markets. We saw a significant shakeup following major Bitcoin sales and a noticeable slowdown in ETF activity. This led to a sharp downturn, liquidating hundreds of millions in leveraged positions and impacting major altcoins. What does this mean for your portfolio? We're diving deep into the whale movements and the data that shows a broad sell-off pressure. Then, we're looking ahead to a potential seismic shift. Will Ethereum actually flip Bitcoin by 2030? We're breaking down the tech, the adoption rates, and the investor sentiment that suggests a major change could be on the horizon. It's a battle of narratives, digital gold versus the world computer, and the stakes couldn't be higher. Next, we're tracking the institutional money. Reports show a clear trend of capital moving towards Ethereum, even as Bitcoin faces its own turbulence and significant liquidations. What's driving this rotation, and what does it signal for the broader market sentiment? We've got the analyst takes and the flow data you need to understand this critical pivot. And finally, we're talking about the exodus. Why is Ethereum suddenly outshining Bitcoin in the eyes of major investors in 2025? We're dissecting the reasons behind this institutional preference and what it means for the future dominance of these two crypto titans. Stick around because you need to know this. Don't forget to smash that like button, subscribe to Bitcoin Bulletin, and ring that notification bell so you never miss an update. Market tremors hit crypto hard. The crypto markets experienced a significant downturn on Monday, with Bitcoin prices briefly dipping below $111,000. This sharp decline was triggered by substantial Bitcoin sales on Sunday, which not only halted Ethereum's rally after it hit a fresh all-time high, but also led to the liquidation of hundreds of millions of dollars in leveraged long positions across the market. The broader altcoin sector felt the pressure, with XRP dropping 2.4% to $2.96, BNB losing 0.6% to $864, and Solana falling 4.9% to $197. The total cryptocurrency market capitalization saw a 2.2% decrease, settling at $3.96 trillion. Data from CoinGlass revealed that over $860 million in leveraged crypto positions were liquidated in the preceding 24 hours, with Ethereum and Bitcoin accounting for the largest portions, at over $308 million and $283 million respectively. This event followed a period of slowing inflows into spot Bitcoin and Ethereum ETFs, which had already experienced significant outflows in the previous week. Spot BTC ETFs recorded withdrawals totaling $1.17 billion, marking the second-largest weekly outflow on record, while spot ETH ETFs saw outflows of $237.7 million, the third-largest weekly drop. The flash crash on Sunday, which briefly pushed Bitcoin below the $111,000 mark, resulted in the liquidation of over $150 million in long positions, identified as one of the most substantial liquidation events since December 2024 by analytics firm Glassnode. This sell-off was reportedly amplified by massive trades executed on Unit, a decentralized spot platform on Hyperliquid. An unidentified whale was reported to have sold over 19,660 BTC, valued at approximately $2.2 billion, and purchased 455,672 ETH over a 4-day period. This activity reportedly drove 24-hour spot volumes to a record $3.2 billion, surpassing the combined volumes of major exchanges like Coinbase and Bybit. Glassnode analysts observed that all Bitcoin cohorts have now decisively moved into a distribution phase, indicating broad sell-side pressure emerging across the market. Concurrently, Ethereum had reached a new all-time high of $4,946 before retreating to $4,631. Glassnode noted that Ethereum's ascent pushed its MVRV ratio to 2.15, signifying that investors, on average, hold unrealized gains exceeding 2.15 times their investment. This metric is comparable to market structures seen in March 2024 and December 2020, periods that preceded significant market volatility and profit-taking. Despite the broader market downturn, notable accumulation activity occurred. Tom Lee's BitMine reportedly invested $800 million in Ethereum last week, increasing its holdings to over 1.7 million ETH, 192 BTC, and substantial cash reserves. Similarly, Michael Saylor's MicroStrategy continued its Bitcoin acquisition strategy, adding 3,081 BTC to its reserves, bringing its total holdings to 632,457 BTC. These contrasting moves highlight differing strategies among major market participants amidst market fluctuations. But what does this volatility mean for the long-term trajectory of digital assets? Get ready, because we're about to explore if Ethereum can truly challenge Bitcoin's dominance by 2030. Ethereum's ascent, can it flip Bitcoin by 2030? The age-old question in the crypto world is whether Ethereum, the powerhouse of smart contracts and decentralized applications, can eventually surpass Bitcoin, the original digital gold, in total value. This potential shift, dubbed the Flippening, is gaining traction as a mix of technological advancements, evolving investor preferences, and a dynamic global economy reshape the cryptocurrency landscape. By 2030, the battle for dominance isn't just about price, but about which blockchain will fundamentally shape the future of online finance. At their core, Bitcoin and Ethereum represent distinct visions. Bitcoin champions itself as a scarce, inflation-resistant store of value, often compared to digital gold. Its fixed supply of 21 million coins, secured by a robust consensus mechanism and periodic halvings, appeals to investors seeking a hedge against traditional financial systems. Ethereum, however, aims to be a decentralized global computer, a platform for smart contracts that power a vast ecosystem of decentralized applications, DApps, including decentralized finance, DeFi, and non-fungible tokens, NFTs. Investing in ETH is often a bet on the success and widespread adoption of this open finance vision. On-chain data reveals a significant disparity in network activity. Ethereum's network is demonstrably more active, handling a substantially higher volume of transactions. Projections suggest that in the first half of 2025, Ethereum could process around 1.74 billion transactions, dwarfing Bitcoin's estimated 398 million. When considering its Layer 2 scaling solutions, Ethereum's daily transaction count could surge to 9.6 million, a stark contrast to Bitcoin's 1.25 million. This difference is largely attributed to the ongoing development and activity within Ethereum's ecosystem, with its Layer 2 networks alone locking up over $42 billion in value across platforms like Arbitrum, Base, and Optimism. The need for ETH to pay gas fees for these transactions solidifies its role as a functional utility rather than just a speculative asset. Both networks are actively addressing scalability limitations. Ethereum's strategy heavily relies on Layer 2 solutions, which act as express lanes, enabling faster and cheaper transactions. Bitcoin is also evolving with its Lightning Network for small payments and projects like stacks that integrate smart contract capabilities. However, Ethereum's current Layer 2 infrastructure is more mature and handles significantly more economic activity. The influx of institutional capital, particularly through ETFs, has added fuel to the debate, with institutions backing each asset for different reasons. Bitcoin is often viewed as a macro hedge, while Ethereum is increasingly seen as a high-growth technology play. This is reflected in ETF inflows, where Ethereum ETFs have shown robust demand, sometimes exceeding Bitcoin's, signaling institutional confidence in ETH's utility and potential for yield generation through staking. Ethereum's transition to proof-of-stake, PoS, in 2022 was a pivotal moment, drastically reducing its energy consumption by an estimated 99.95%. This environmental advantage addresses a key concern for many institutional investors, particularly those with ESG mandates. Meanwhile, regulatory clarity is slowly emerging globally, with regions like Europe establishing frameworks and the US making incremental progress, which is expected to foster greater institutional comfort with digital assets. The burgeoning market for tokenized real-world assets, RUA, estimated to reach $30 trillion by 2030, presents a significant opportunity, and Ethereum is currently leading the charge, hosting the majority of the approximately $24 billion already tokenized. While Bitcoin-based projects are emerging, Ethereum's established infrastructure and standards give it a substantial head start. While a complete flip by 2030 is not guaranteed, Ethereum's performance in transaction volume and developer activity is already outperforming Bitcoin. For Ethereum to capture the top spot, its DApp ecosystem must continue to expand, becoming the foundational financial layer of the Internet, supported by its efficient Layer 2 solutions and dominance in the RWA market. However, Bitcoin's enduring narrative of security, scarcity, and simplicity remains a powerful force, making it a formidable contender in the long-term race for digital asset supremacy. While the debate rages on about which digital asset will reign supreme, a clear trend is emerging in institutional investment flows. Prepare yourself as we dissect the latest data showing where the big money is moving and why Bitcoin might be facing turbulence. Institutional capital shifts. Ethereum gains traction amidst Bitcoin's volatility. Max Kaiser has projected a staggering future for Bitcoin, suggesting it could reach $2.2 million, primarily driven by concerns over escalating U.S. national debt and potential inflationary pressures. This bold prediction underscores the ongoing debate surrounding Bitcoin's efficacy as a hedge against the devaluation of fiat currencies. However, recent market dynamics paint a more complex picture, with institutional capital showing a discernible shift towards Ethereum, even as Bitcoin navigates significant volatility and substantial liquidations. The cryptocurrency market experienced a notable flash crash over the weekend of August 25, 2025. This downturn saw Bitcoin's price plummet below $111,000, following a massive sell-off of approximately 24,000 BTC, valued at over $300 million. This event resulted in over $550 million in liquidations across the market, with Bitcoin positions accounting for $238 million and Ether positions for $216 million within a single day. The sharp decline effectively erased the gains that investors had accrued following Federal Reserve Chair Jerome Powell's dovish remarks at the Jackson Hole Economic Policy Symposium earlier in the week, which had initially boosted market optimism. In contrast to Bitcoin's turbulence, Ethereum demonstrated remarkable resilience, trading at $4,707 the following day. Analysts point to a growing institutional preference for Ethereum, especially as the Federal Reserve's potential interest rate cuts are anticipated to benefit smaller market capitalization assets, a category into which Ethereum is increasingly being placed by institutional investors. Ethereum's expanding utility in areas such as stablecoins, smart contract execution, and the tokenization of real-world assets further bolsters its appeal, with some experts suggesting it could become a foundational asset for the future of traditional finance. The broader cryptocurrency exchange-traded product, ETP, market also reflected this market sentiment. Last week witnessed outflows totaling $1.43 billion from crypto ETPs, representing the most significant weekly outflows since March 2025. Bitcoin ETPs bore the brunt of this trend, experiencing outflows exceeding $1 billion. Ethereum ETPs, while also seeing outflows, were comparatively less affected, with $440 million exiting. James Butterfill of CoinShares attributed this sell-off to a polarized investor sentiment, heavily influenced by the market's interpretation of the Federal Reserve's Jackson Hole speech, which was perceived as more dovish than anticipated. A key observation from these ETP flows is the divergence in institutional interest year-to-date. Ethereum has captured approximately 26% of total ETP inflows, significantly outpacing Bitcoin's 11%. This suggests a growing institutional appetite for altcoins, with inflows also noted for XRP and Solana, although other assets like Sway and Tonkin experienced outflows. This dynamic behavior highlights the market's sensitivity to macroeconomic factors and the evolving perception of digital assets' value propositions. The recent price volatility, marked by the flash crash and subsequent liquidations, underscores the inherent risks associated with leveraged trading in the digital asset space. Liquidations, triggered by significant price movements against open positions, can exacerbate short-term volatility and reset market sentiment. The sequence of events, from Powell's comments to the whale sell-off and subsequent market stabilization, illustrates the rapid and often unpredictable shifts in digital asset valuations, heavily influenced by macroeconomic signals and large-scale holder activity. These market movements are not isolated incidents. They reflect broader trends in how institutions are viewing the digital asset landscape. Prepare yourself as we dive into the reasons why Ethereum is increasingly being seen as the favored investment over Bitcoin in 2025. The institutional exodus: why Ethereum is outpacing Bitcoin in 2025. In the rapidly evolving world of digital assets, a significant trend is emerging. Institutional investors are increasingly favoring Ethereum over Bitcoin. This shift, particularly pronounced in 2025, signals a potential reevaluation of the market leaders, driven by Ethereum's technological advancements, expanding use cases, and a more favorable perception among large capital allocators. While Bitcoin remains the benchmark digital asset, Ethereum's growing utility and ecosystem growth are capturing significant institutional attention. Several factors contribute to Ethereum's rising appeal to institutional investors. Firstly, its technological roadmap, particularly the ongoing development of its Layer 2 scaling solutions like Arbitrum, Optimism, and Base, addresses critical issues of transaction speed and cost. These advancements make Ethereum a more viable platform for widespread adoption in decentralized finance, DeFi, non-fungible tokens, NFTs, and the burgeoning market for tokenized real-world assets, RWAs. The ability to handle a higher volume of transactions at lower costs makes Ethereum a more practical choice for complex financial applications. Secondly, Ethereum's transition to a proof-of-stake, PoS consensus mechanism has significantly reduced its environmental impact. This green credential is crucial for many institutional investors, particularly those adhering to environmental, social, and governance (ESG) mandates. By drastically cutting energy consumption compared to Bitcoin's proof-of-work (POW) system, Ethereum has become a more palatable investment for funds that prioritize sustainability. Thirdly, the narrative surrounding Ethereum is shifting from being merely a speculative asset to a foundational layer for Web3 and the tokenized economy. Its smart contract capabilities enable a vast array of innovative applications, and its growing dominance in the RWA tokenization space, estimated to be a multi-trillion-dollar market by 2030, positions it as a critical infrastructure for future financial systems. Institutions are recognizing the potential for Ethereum to generate yield through staking and to capture value from the increasing digitization of assets. This institutional preference is evident in the flows into cryptocurrency exchange-traded products, ETPs. Data indicates that while Bitcoin ETPs have experienced significant outflows recently, Ethereum ETPs have seen more sustained inflows, capturing a larger percentage of year-to-date institutional capital. This divergence suggests that smart money is actively seeking exposure to Ethereum's growth potential, viewing it as a high-growth technology asset akin to a digital stock, whereas Bitcoin is often seen as a more conservative, store-of-value play. Furthermore, regulatory clarity, though still evolving, is gradually improving. As regulatory frameworks become more defined, institutions are becoming more comfortable allocating capital to digital assets. Ethereum's established ecosystem, its clear utility, and its perceived growth trajectory make it an attractive option for institutions looking to diversify their portfolios into this emerging asset class. While Bitcoin's status as digital gold and its robust security remain compelling attributes, Ethereum's expanding utility, technological innovation, and increasing institutional adoption suggest a strong case for its continued outperformance. The race between these two digital titans is far from over, but the current trends indicate that Ethereum is steadily gaining ground in the institutional investment landscape. These shifts in institutional sentiment and market performance highlight the dynamic nature of the crypto space. Now, let's quickly recap the key takeaways from today's critical updates and what you need to know moving forward. All right, that's a wrap on today's market movers. We saw Bitcoin face turbulence with major whale sales and ETF outflows, while Ethereum showed resilience and institutional interest. The big question remains, will Ethereum flip Bitcoin by 2030 with its expanding ecosystem and institutional adoption? Plus, we've seen a significant institutional shift towards Ethereum even as Bitcoin navigates volatility. Don't miss out on these vital insights. If you found this breakdown valuable, give us a massive thumbs up, subscribe to Bitcoin Bulletin for all your crypto news, and hit that notification bell so you're always in the loop. Follow us on all social platforms for more real-time updates. We'll see you in the next one.